Good evening, everyone. We welcome you all in this very interactive and thoughtful webinar. And this is the second which we have organized in less than 3 months' time on the demand of many of you who would have attended our previous webinar as well. And before we come to the core of the webinar, and before we invite our prominent speaker who are seasoned and very experienced speakers from two different background, let me introduce our guest of honor today, Mr. Arun Karna. He's a managing director and CEO at AT&T Global Network Services India Private Limited. Arun is a highly experienced technology business leader with more than 34 years of experience in the telecom and IT industry. He has been with AT&T for more than 23 years and currently the managing director and CEO of AT&T Global Network Services India Private Limited. He's as well regional president, North Indian Council at the Indo-American Chamber of Commerce. He's a member of the B20 Task Force on Technology, Innovation and R&D. Additionally, he's a core member CI Delhi State Tech Panel. He was recently elected as a chair of the North Region Council, Gurugram at NASSCOM. In his previous assignments, he has worked with well-known brands such as HCL, HP, Modi, Olivetti, and BT. Arun is a sought-after speaker and thought leader. Arun is a mentor and advisor to a couple of young startups in the technology space. He's an extremely effective coach and mentor of teams and is adept at providing leadership in a global cross-culture environment. He holds a PGDM specializing in marketing and finance from IMT Ghaziabad and B Electronics and Telecom from Pune University. So over to you, Arun. Our audience wants to hear your perspective before we go to the topic of the day.
Akhil, thank you so much for that warm introduction. Good evening, esteemed participants and distinguished speakers. On behalf of the Indo-American Chamber of Commerce, it gives me great pleasure to welcome you all to this insightful webinar, where we will be discussing the guide to growing your business in the United States of America. As the regional president of the Indo-American Chamber of Commerce, I'm committed to strengthening the relationship between India and the United States through increased bilateral trade and investment. By providing resources and guidance to our members, we aim to facilitate the expansion of Indian businesses into the lucrative US market. The United States remains a beacon of innovation, entrepreneurship, and economic prosperity, attracting businesses and investors from around the globe. Its vibrant economy, coupled with a robust legal framework and a culture that celebrates innovation, makes it an ideal destination for those looking to establish and grow their businesses. However, venturing into the US market can be a daunting task, especially for those unfamiliar with its legal and regulatory requirements. Our two nations share deep-rooted ties, forged through trade, technology, and a shared commitment to democracy and economic growth. By leveraging our collective strengths and expertise, we can unlock new opportunities for growth and prosperity on both sides of the globe. Today, we have an eminent keynote speaker. We are honored to welcome again Mr. Kris Sharma, who is the owner and president of Orbit Institutes Private Limited, US India Tax Incorporated, who brings a wealth of experience and expertise to this discussion, along with esteemed speakers like Ms. Nikita Gulati, Director, Grand Thornton Bharat, and Mr. Akhil Chandna, who's the chairman of our BFSI committee at NIC-IACC, and he's also the partner, Grand Thornton Bharat. I encourage you all to actively engage with our speakers, ask questions, and make the most of their insights. I would invite Mr. Akhil Chandna, who is the chairman of our Banking, Financial Services, and Insurance Committee at NIC-IACC, to moderate the session. I do not doubt that today's webinar will serve as a valuable resource for all those seeking to embark on their entrepreneurial journey in the United States. Thank you, and over to you, Akhil.
Thanks, Arun, for such an insightful, details and setting up the context. Though Arun has given, some bit of background about our prominent speakers, but let me give a brief introduction and more detail with the speakers. You will be interacting, you will be asking your questions, and who is taking us through, the entire landscape of how the things have been, on the US compliance side when you are intending to, form your company, how it should look like. So Nikita Gulati, our first speaker, she's a director, Thornton Bharat. She comes with 13 years of experience in federal and state taxation. She's delivered on all-round responsibilities for preparing and filing of consolidated US tax returns of companies like McKinsey and Company and 4 other large corporates with IRS, along with the, preparing number of various US individual, federal, and state tax returns. She's expertise in individual taxes, corporate taxes, financial analysis, planning and forecasting with, with a lot of, participation in different forums. And then she's been actively presenting and giving a lot of insights. And we are also hopeful that we'll get, because we've heard Kris last time, but this time we've got Nikita also. And then we are very hopeful that we'll get more insights on how the things looks like. So she's responsible for managing and reviewing the end-to-end federal and state tax preparation, filing for various US individual corporate partnership clients, which includes, responsible finalization of tax competition with review of tax forms such as Form 1120, 5471, 5472. So this is a huge list. I don't want to take much time here. So this is a background. Looking forward to interact with you, Nikita. And now let me give a bit of update on Kris Sharma. He likes to be called as Kris. He's the owner and president at Orbit Institutes Private Limited, US India Tax Incorporation. He's a CPA by qualification, even CGA from Canada, MBA and CA as well. He's a US citizen. He has 30 years of experience in audit, accounts, finance, US, Indian taxation, financial advice services with a lot of MNCs. He's president Becker CPA review courses in India since 1997. He's president US Tax, India Tax since 2006. So along as we have a lot of experience from Kris, so we are hopeful that we'll get something additional to what we have already discussed and hear from him in the last conversation. So looking forward to have your inputs as well, sir. Now let's go to the topic of the day for which we've conducted this webinar and for which everyone is waiting. I'll ask my team to put up the presentation, and I'll like to invite Nikita to take us through the integrities and the discussion around how to set up an entity in US, what are the primary steps involved in setting up a business entity in the United States, and so on. So over to you, Nikita.
Thank you so much, Akhil, for the warm welcome, and thank you, Arun, as well for the wonderful background and the to begin with it. And I even want to thank my participants for joining us today. I request Barbie to put up the slides. Our topic for the day is setting up of a business in US and its compliances. Just to give you a background, I'll be walking you through around what are the nuances that if somebody is looking forward to set up an entity in the US. We all know that for expansion purposes or for other funding aspects from different investors, United States is one of the countries where a lot of business can be generated. Hence, not just India, other countries are also reaching out to set up. But having said that, there are multiple compliances which one tends to miss out. So starting from understanding what are the steps which takes to set up an entity in the US, and what are the primary important critical compliances that one needs to take care of, so that the hefty penalties which the IRS applies, it should not be a part of your case. So I request Barbie to move to the first slide. In nutshell, there are 6 steps, but to take care of each step, we first want, one needs to understand that what are the different type of entities one can set up in the US. It starts from setting up a C corporation, LLC, partnership, sole proprietorship, or non-profit entity as well. We would be, understanding each type of entity in detail, but first, to understand the preference or the reason why we are setting up, this is where the type of entity becomes very crucial. In the US, not just from the federal perspective, but from the state tax law perspective as well, one needs to be very, very careful and understanding in which particular state the entity should be incorporated. The reason being, every state has its different nuances again. It can range from different cost pricing. It can range from whether a particular person can be a director or not, specifically addressing concerns around whether a non-resident can be a director in a particular entity for a particular state or not. So there are multiple reasons one needs to be addressed while deciding the state of formation. Just to highlight, the preferred state in the US for incorporating an entity is the Delaware state. The only reason being the corporate law in the Delaware state is quite flexible. It is more pro shareholders, that if there's any judgment needs to be taken care of, that's taken care by the perspective of judges and not by judiciary. So these are the reasons primary, which most of the entities you would see in the past and in present preferring to set up an entity in Delaware state. Third step is very important, though easier it seems, that choosing a name of the entity, it has to be unique and it has to be abided with the rules and regulation of the state in which you are looking forward to incorporate an entity. Next step is to file the formation documents. As I said, that there are, a state, it wholly depends on which particular state you are looking forward to incorporate an entity, and that will definitely go by the goal of your entity where you're looking forward to expand. But the preferred state, as I just mentioned, Delaware. So going by that example, there is a first number one important form which needs to be filed, which is called Article of Association. That will include the entity's name, address, and primarily the promoters or the directors, which are the initial directors to be called, that needs to be mentioned. Very important to highlight here is that in the US, you cannot set up an entity on your own. You require a registered agent. Registered agent is like a connection between you, your entity, and the state authorities. Their job is to pass on the notices or important communication from the state perspective. So without the registered agent, this entire process cannot be done. There is an annual fees which is attached to keep the registered agent, of course, and that's part and parcel of the entire setting up of the cost expenses for the entity incorporation. And similarly, lastly, the document would require you to mention the purpose of incorporation. So these are the first initial steps to thought through why you are looking forward to form an entity and what kind of entity you're looking forward to form, so that it gets aligned with the objective of setting up an entity in the US. Once you are setting up, already created an entity in the US, an important aspect is to file a form called Form SS4. It is the employer identification number. It is a very unique ID known as tax identification number, also issued by the IRS to your specific entity. Going forward, whenever if you are having any calls with the IRS or state authorities for any matter related to incorporation, that particular ID is your unique. That needs to be given to address any concerns related to that. So it's very important while filling up the form called SS4, certain nitty-gritties again have to be carefully mentioned, specifically around deciding the tax period for your entity. I would like to address very important point here that from India perspective, if your entity is a hold company, which is a parent company, and looking forward to form a subsidiary, a lot of time what we have seen as per our experience that US follows a tax period of Jan to December. However, in India, we follow the April to March financial year. Hence, for the consolidation perspective, or sometimes filing the tax returns also for different reasons, these two tax years does not match well with one another. So it is very important at this stage to decide which particular tax period one needs to be mentioned. Again, the forms also requires mentioning of the responsible parties. Another important key takeaway which I would like to highlight here, that the dimension of responsible parties become very important at this stage, and specifically in this year. There has been an important introduction of Corporate Transparency Act recently being introduced, which talks about mentioning the beneficial owner information in a different format altogether. So whosoever details you're going to mention while forming your entity or as part of filing an EIN, it becomes very important that who's that person who's ready to take up the responsibility or going to make the controlling decisions for the firm. That name should be mentioned. So hence, these are the important points while you're making any, the address to take care of the EIN application. Last but not the least, opening a bank account. Seems a very simple step, but being in India, setting up of an entity in the US, that can very well be done by being present here. You do not have to travel. Similarly, for the bank accounts, all the primary banks in India are taking care to assess entities when they are looking forward to set up any business in the US. So these are the 6 steps in nutshell one needs to take care of. But before I conclude this particular slide, my recommendation is that do not miss on the points related to tax period, the beneficial owners while you're deciding on, or the related compliances, which starts with thinking through what kind of an entity structure I am looking forward to incorporate as part of my entire group structure. Is it the holdco, which... Yes, Akhil.
Yeah, I think wonderful insight, I must say, Nikita. The way you detailed out each and everything. I have my question. Sorry, I was not able to hold up. What are the various types of business structures, options available in US? If you would like to highlight, maybe you're covering in the next slide, but I thought I'll ask that question. And if you can just give a high level, on the timelines and the costs associated while setting up entity.
Sure.
Maybe you just for the benefit of everyone. Thank you.
Thank you so much, Akhil. That's a wonderful question because, as I said, the point number 1 is to understand the type of entity. So I request Barbie to take us to the next slide. Thank you, Barbie. So there are different type of entities in the US, of course, and we'll be addressing the first 5 focused here. Number 1, of course, likewise, we have a sole proprietorship business in India. We do have it in US as well, that option. In this particular form, one needs to, the entity does not pay the taxes. It's primarily an individual who's forming an entity. That person needs to file a tax return and applicable taxes needs to be formed. Important point is to focus on the next 3 or 4 other entities. Let's start with understanding the partnership type of entity. It is when 2 or more people, gather together to form a business for any specific venture. They can look forward to do that by way of creating a partnership. While doing that partnership, the first step in the US is to either you can first set up a limited liability company. It is again a pass-through taxation type of an entity where one entity does not pay taxes, but the owners of those entities may pay the taxes through their personal tax account. These type of entities, both combining LLC or partnership, are subject to taxes like franchisee tax, annual report fees, or there are multiple taxes like other applicable for payroll related. However, these can also be elected as a corporation or partnership. A very, very important point to understand here that once you have set up an LLC, you have an option to convert that entity into a different type of entity, which could be C corporation or partnership. A very simple example, how can it be done? A single member limited liability company is created by a single person, and hence the taxation forms on the person who's owning or creating that entity. However, in a later stage, when a business is expanding, you are including more people as partners. So that can be converted automatically in a partnership. That is called a default classification in the US. However, if the business objective further is getting changed, you're looking forward not to have a personal liability on yourself from any perspective, but a limited liability is the protection angle which one needs to address. Then in that case, C corporation is another type of entity which can be elected by filing certain specific forms, one specific in nature called 8832, and then you can elect your entity as a C corporation. I'll be discussing a little more on C corporation, a very well preferred entity in the US. Reason being that it is separate, it is distinct from its owners. However, it is subject to double taxation. That's the only difference between pass-through entities and a C Corp. In a double taxation, the entity has to pay the taxes on its own, and then whatever is being passed on to its owners called shareholders in the form of dividend, they again also have to pay taxes on that. Hence, C Corporation is a very typical but a preferred entity to be set up in the US. Parallel to that, C Corporation, there is another entity called S Corporation. The difference between the two entities primarily is that S Corporation is again a pass-through entity where an individual or an entity for being formed does not have to pay any taxes in particular, but the owners have to make the taxes on it. However, it only gives you one class of stock to be created. There cannot be multiple classes of stock, and it also gives a restriction that only the US citizen or residents can form an S corporation entity. There cannot be non-resident. Wherein, for example, we are Indians looking forward to set up an entity in the US. That is why a C corporation is preferred, because a non-resident can easily form an entity in the US. S corporation also has a limited on the number of participants or partners in that set. That is restricted to 100, wherein in case of C corporation, there can be multiple shareholders attached to it. So these are the primary type of entities when someone is looking forward to create in terms of profit creation. However, on the other side, the objective is non-profit. Then we do have an entity type which is called non-profit corporation. It is again formed for the purpose of not limited to profit, and it can be elected as a tax exempt status. So happy to answer any question Akhil or anyone else has on this particular slide.
Nikita, I'll just like to add a few things here.
Please.
Number one, the first thing to understand is that all entities are started off by registering with a particular state. So you don't apply to the federal government, you apply to the state government. So, you select Delaware, you select Florida, you select New York. So some of the states are, free of income tax at the individual level, but not at the corporate level. Now, the other thing to understand is that what is the difference between flow-through entities and a regular C corporation? So, when we look at a C corporation, you can think of a C corporation like a private limited company in India, which can own assets, pays its own tax. Now, when it comes to flow-through entities, the flow-through entities are just basically you file the returns for record purposes, but through a mechanism called K1, Form K1, the income of the flow-through entities is allocated to the owners, to the shareholders, or to the partners and all the stuff. So when we look at the year ends of flow-through entities, partnerships, or S corporations, then a limited liability corporation is basically you set up a limited liability corporation, and what that really means is that your liability for that corporation is limited to your invested capital. But on its own, you have to make an election whether your limited liability corporation will be treated as a partnership or as a C Corp or as a single member LLC or as an S Corp. And then, of course, through the mechanism of Form K1, your income is allocated to the partners. Now, when it comes to partnerships also, there is a couple of things to understand. We can have partnership where everybody is a general partner. So what does that really mean? In that the liability of all the partners in a partnership is equal. They are for that. Or you can have a limited liability partnership where one could be a general partner, the other partners could be limited to the invested capital. So in selecting, and the other thing that we keep bear in mind is when it comes to partnerships, are you an active partner? Is it active income that is going to be generated to you through a form called K1? Or are you a passive partner? Are you going to get passive income from the partnership? So the difference why we try to discriminate between active income and passive income is because the rules of setting of losses against other income come into play. Anybody who's an active partner can offset his active income loss against his salary income. Whereas if you're a passive partner, you cannot offset your passive losses against your, W-2 or your salary income and all the stuff here. So, and all these flow-through entities have an year end, which has to sort of, align with the individual filer's year end. So generally for all flow-through entities, the year end is always December 31st. But for C Corps, you can pick up any year end that you like. So I just wanted to, okay, the other difference, I'll give an example. So we set up, Sharma Marcus and Associates is one of my CPA firms. So it was set up as an LLC between me and my son, and it was a general partnership. But so in a general partnership, because we both were general partners, all the income of the partnership was taxed. And when you pay taxation in the US, you're paying income tax and also on active income. On active income of a partnership, you're levied social security taxes. So then we filed an election, just like Nikita said that once you have a flow-through entity, you can change the classification, you can change it to a corporation, C corporation, can change it to an S corporation. So we filed that election after 1 year and changed the partnership to an S corporation. So what is the difference between a partnership and an S corporation? And of course, in S corporation, investors are limited to citizens of India, of US, Canada, or Mexico, and limited to 100 people, one general class of shares, all individuals. But the difference is that, for S corporations, the income that is allocated to you through a Form K1 does not attract Social Security. Whereas partnership income was Social Security. And, later on, there's a slide which we can discuss about in detail about this Social Security, implications when you have active income versus passive income. So, Nitik, I just wanted to add that in. So I think we're over with that.
Yeah, thanks, Mr. Sharma. So, Nikita, though we have a lot of questions, but quickly, I want you to attend, first two. So people are asking, do you need to retain the agent in perpetuity? That's required always, or it's a limited time that you have to keep the agent? How it works?
So yes, as long as the entity is in existence, you have to maintain the registered agent till perpetuity. You have to make an annual payment for them. And in case you do not, or you miss paying to the registered agent in any of the year, the entity status can become inactive. So it's very important to maintain the registered agent in the US.
Thank you. And another question is that people are asking, can we change the tax period from April to March? Or January to December, or vice versa? Can they do that? I think Mr. Kris said something, but yeah, I want to hear from you.
For C corporations, we can change, but for flow-through entities where the income gets allocated to the individual partners, for all the individual partners, the calendar year is the applicable year. So it is a January to December year for all flow-through entities. And for C corporations, it is you can choose any year at all. So that is why what happens is, when we file tax returns for individuals, the filing date is April 15th. But for all flow-through entities, the filing date is 2.5 months after December 31st. So by March 15th, I have to file my tax return for Sharma Marcus and Associates, which is an S corp, because that S corp has to generate a K1, which is the allocation of S corporation, which I'm going to use to file my individual return, for which the due date is April 15th. So so to answer that, for all flow-through entities, you have to abide by the January to December year, and for C corporations, you can choose any year end.
I want to add something here. So for C corporation, particularly any 12-month period or 52 to 53 weeks period can be elected as your tax period. However, it is very important, as I said in my first slide also, that, since you are making this entity as part of your group structure, which primarily have India in picture, and India has a very specific standard financial year to be followed. So it is very important in the first year itself to make sure that what year you are selecting, it should be in line with your India entity, which is April to March. However, if you have elected by some wrong advice that any other period of June to July or Jan to December, you have an option to make the change in the first year, given without any restriction by the IRS. There are certain other criteria also in the later year when you can change that period, which could be in the case of acquisitions and mergers, but not otherwise. it is restricted. The reason has to be there to change the entity. Or third reason could be that now you have decided to make changes according to some other country law as well, which is following altogether a different period. In that case also, then you have to take the recommendation or the permission from the IRS. You cannot do it automatically. So the question the participant asked, it has two-folded answer to it. Number one, you can do it, but please be careful while electing the period in the first year itself. And if you are doing it on the later years, any which ways, then you have to be mindful whether it is an automatic election or you need any confirmation from the IRS. So that reason has to be very specific. Along with that, Akhil, I want to also address one more point, though we talked about an individual taxation in between, but specifically we are talking about setting up an entity. We talked about incorporating an entity in the US. Now there is another aspect in the US from the state perspective of registering the entities. Now one has assumed that I want to expand my business in the US, but of course they'll not be restricting their expansion to one particular entity where they have incorporated it. Incorporation state, one needs to understand, it's from the business law perspective that how an entity is going to be protected if there's any liability going to happen, if there is any any concerns around that. But what if I'm expanding my business to other 50 states in the US? How am I going to manage that? So that specific angle is called as registration process in the US. So if you're doing any business in the US, you have to get yourself registered in those particular states as well and pay the applicable taxes. As Mr. Kris rightly mentioned, there are certain states, to be total number is 7, which do not apply or imply any income tax in those particular states. However, the remaining ones do ask for that. So it's just not that one random day you decide that I'm going to sell my any tangible property or intangible business I'm conducting and expand in California, Florida, New York, New Jersey, just like that. You need to be mindful that specific return needs to be filed. Taxes are to be done properly, but most importantly, a registration should be taken care of. If that's the step not being taken care of, then the hefty penalties is what each state applies on, and it counted as on a day basis when it is being delayed. So that is one point which I really wanted to highlight.
That's fantastic. I think the kind of insights you and Mr. Kris has given. And interest of time, let's move to the next slides, please, because we have a lot to cover, and we have a lot of questions as well. But I think I'll stick to the three, 4 major questions which you've already answered. Now let's move to the next slide, please, Nikita.
Okay, just one more addition. Nikita rightly said that we have to register an entity. Now, where do we register an entity? Which state do we register an entity? Like, I'm a business. I'm selling my merchandise in 20 states. Do I need to register in those 20 states? So the two things to understand is that number one, for user tax. So sales tax is a consumption tax. It is levied, where the item is consumed. So there's a sales tax registration that you have to do. But when it comes to income tax, the rules are very simple. That there's a treaty called Nexus Treaty. Nexus Treaty means it's a treaty amongst all the states. I'm a company registered in Delaware, but I'm selling to 20 states. Should I pay my income tax to 20 states and all? So one simple method of allocation of income to a particular state is determined by 3 factors. Do you have employees in that state? Do you have a permanent setup in that state? Are you doing direct marketing and solicitation in that state also? If you're not doing it, suppose I'm based in Delaware, and I'm just I'm doing internet sales in California. I don't have any employees. I don't have any infrastructure. Then I'm not liable for California income tax. I'll be liable for a consumption tax. I'll be liable for sales tax. I'll be liable, but for income tax, if I don't have those 3 things, I don't have employees, I don't have a structure, I don't do direct marketing in that state, then I would only be paying tax to the home state. Yeah, just wanted to add that. Yeah.
Fine, Nikita, can we move to the next slide, please? Yeah.
Yes. Thanks, Akhil. So the next topic is related to what we just discussed about understanding the business structures in the US. There are certain, default classifications already for the entity existing. For example, we discussed that there is a single member LLC. if that entity is being owned now at a later period by 2 or more people, then that entity can, from the US perspective, can automatically be classified as a partnership. So that's called default classification. The focus here is to understand from India perspective, there are certain type of entities in India, as we know. Number one is partnership. If there is, from a US perspective, if we have a US shareholder who owns a foreign entity, in this scenario, let's take an example, India itself, and that India entity is a partnership from a partnership definition of India perspective. However, from US angle, we need to include those such entities from a reporting purposes for that US shareholder. And now what that entity type should be for that US person to report? Will that be a partnership entity as it is in India, or is it something other type of entity? So you have to have that lens to understand that it will be concluded from a US perspective for whatever type of entity it's in discussion from a non-US perspective, that has to meet the definition of US law. In case of partnership, for example, if there are 2 or more members and there is just one limited liability person, then that person can be, that entity can be, classified as a partnership for a US perspective. And there are certain applicable forms attached to US filing. Just to name here, one is 8865, which gets filed along with the tax return. Similarly, in the US, in India, we have limited liability companies. All the partners having a limited liability, then from the US perspective, that will be called as a corporation, the C Corp, which we recently discussed. So these are the 2 important points I wanted to take up here, because while people tend to miss these angles, they assume simply that whatever type of entity we have in India, it is equivalent or mirroring it same in the US as well. However, the classification totally changes. And why we are discussing it, its importance is because the form applicability also changes according to that. And if you're not filing the correct form attached to it, there are very, very hefty penalties, material amount attached to it for selecting a wrong form altogether. Any questions on this part? Otherwise, let's take up the next slide, which is about the due dates to understand.
I think we can move. We can take the questions later. But it's important to understand the compliance requirements in the US and the respective deadlines as well. Yeah.
Thanks, Akhil. So very important, US has a lot of compliances. It revolves, or rather goes entire year, and it begins with the first month of the year itself, which is first due on 31st January. There's a specific form called 1099. 1099 has a series of form for different applicability. Just to give a perspective that if an entity has paid to any consultant for its professional services, then an applicable form of 1099 NEC is what gets triggered. And the due date to file those forms is 31st January. Very important for Indian promoters setting up an entity in the US to understand this, because it gets, again, tend to be missed, because all they understand sometimes is it's the only federal or the state tax return which needs to be filed. However, these are the additional compliances one needs to be filing it. It is also filed at a federal as well as at a state level. Then there are forms, form called 3921. It is related to the incentive stock options. If you have issued and it has its applicability, all that has been taken care of, then this is the one, again, another form which gets filed on the 31st of January. Followed by that, a very, very important due date falling on 15th March. It is the due date for the partnership income tax return. Then there is another form called 1042 and its related series S&T. It's more related to 1099. In 1099, all the payments are being made to the US entities or US person. However, in case of 1042, the difference is when a US entity is making a payment to a foreign party. It could be a foreign corporation, foreign person, foreign partnership, any kind of entity, but it has to be foreign. So this is what needs to be filed by 15th March. There is an extension option. We have to understand in the US, for filing of any tax return, primary tax returns, there is an extension option which can be taken, which gives you an extended time to file the return, but it does not give you an extended time to pay the taxes. So in case of partnership income tax return, this is the original due date. However, due to any reason, for example, the financials are not properly being ready at this moment, then an extension can be sought. There is no penalties attached. There is no complications, anything to be concerned about. You can simply file a specific form asking for an extension, and hence the extended due date, which is the point number 5th here, becomes your due date to file the tax return. In this case of partnership, it is 15th September of any year. Another very, very important, and this is what Mr. Kris also highlighted originally, 15th April is the due date from a lot many compliances perspective. Corporation income tax return. Why do we have this 15th April as a corporation income tax return? When any entity has chosen a tax period of Jan to December. So after ending of any tax period, from that period, 3.5 months later, is the due date to file the corporate income tax return. In this scenario, it is restricted to the Jan to December period. However, for the individual income tax return, it is primarily for the US citizens and residents. Their due date is again to file the tax returns by 15th April. Both these type of forms have an option to take an extension to file the return. And in that case, the additional period given is 6 months, and hence the due date, extended due date, which is point number 6, becomes 15th October. So these, another point, as I said, in all of this scenario, you can extend to file your return, but you cannot extend to make the tax payment. So in that case, if you're also delaying your tax payments beyond 15th April, then again, the late payment penalty gets imposed along with the interest as well. So that needs to be taken care of. Lastly, point number 4 is about the 15th June. It is more from the individual income tax return perspective. You would see a confusion here. Then there is, date mentioned at point number 3. Then why again there is a different timeline, 15 June for, US individual. Point here is that if a US person is outside US on the original due date of 15th April, then they get an automatic extension to file their tax return. In that case, their original due date becomes 15th June. However, they also have an option to take an extension and can file their tax returns by 15th October. In this case also, you need to make your final tax payments by 15th June. So all in all, we have to remember that by the original due dates, we have to make the payment, but we have an option to make any extensions. So we may be clubbing certain dates here for the individuals and corporates, but they go hand in hand. So it's very important to understand, because there is a dependency of one another as well. If you do not have a partnership return, the K1, as Mr. Kris was describing, which is an allocation of income by your hand, how will you be able to file your personal tax return? So it's very important to understand the entire thread here, that how one compliance is affecting the another compliance's due date. Last but not the least, 15 December is again an additional 2-month extended timeline to file the personal tax return in the US. Yes, US do, give you an option to take 2 important extended timelines without any worry or without any complexities involved. So these are the primary important timelines to stick to abide to. And there are certain informational forms which also goes along with your respective tax returns, be it corporate, partnership, or individual, which we will be further discussing, and their due dates also when they do get triggered. Over to you, Akhil.
I think, Mr. Sharma, yeah.
There are 2 kinds of penalties that we have. One is for late filing. So if you don't file by the due date, you have to, there's a penalty. And for underpayment of taxes. So whenever you are an entity, you have to make sure that, you do installment payments. And how much should you pay? From one year to another year, you don't know the level of the business. So there are guidelines which tell you how much is your advance payment, installment payments that you do. It should be 100% of your last year's tax liability, or 110%, of the current year, if you can estimate it, whichever is the lower. So we have guidelines. So 2 kinds of penalties: underpayment of tax, and tax has to be paid by the due date, not by the extension date, which is April 15th. Or for S corporations, those are flowed. So April 15th. So second thing, a very quick point is that, there is a law between, wherever there's a difference of less than 3 months in taxation year. Like, here in India, we have a taxation year which ends on March 31st. And in US, the taxation year ends at December. The IRS does allow you to duplicate the entire year, which is what I do also. So I don't proportion my income between 9 months and 3 months. I duplicate the entire Indian income on my US income because the year end differs by 3 months or less. So that's another point I just wanted to bring across, that a lot of taxpayers that we have.
I think we've lost you, sir. There's some network issue. I think very important points, and thanks, Nikita, for giving an overview of federal tax. I can see there's many for the federal, so I can imagine how many compliances at a state level must be required. But thanks. Let's move further. And as I said, we take all the questions in the end. As of now, there are no questions on this particular slide.
Barbie, can we move forward? Yep. Thank you. So we have discussed how we can set up an entity in the US. Then we even talked about that there is federal and state level tax compliances that needs to be followed. The third aspect which I would like to highlight here is that US return requires certain informational forms to be filed along with their primary income tax return. Each form has its own objective to address. However, in the paucity of time, we will be discussing the 4 primary forms, which is heavily needed, or one needs to be understood about the complexities around these forms, because for the sake of any misreporting of these forms, the penalty starts minimum of $10,000. So let's talk about Form 5471. It is called as return of US persons with respect to certain foreign corporations. So to give you an example, let's assume that we have a US entity, which is a parent entity, and underneath we have a subsidiary in India, which is a corporation. So in simple words, US entity is holding 100%, a subsidiary in India. In that case, this particular form needs to be filed. There are many other categories to be understood to make this requirement and file this form. It is a lengthy form which talks about reporting the balance sheet, income statement, classes of different stocks, who are the primary officers in a particular entity, is this entity making any dividend distributions during the year or not. So all of that needs to be understood. However, at the same time, apart from just owning, if the US person is an officer, director as well in the particular non-US entity, specifically India in this case, then also this particular form needs to be followed. There are different schedules attached to this form, asking for different reasons to it. Basis the applicability or the category under which you are meeting this particular form's requirement, then those specific schedule needs to be formed. Now this form gets attached, or rather get filed along with your corporate income tax return only. Here we are discussing about business structure, so I am specifically mentioning corporate income tax return. However, it can get triggered along with an individual tax return also, because there is a possibility that a US shareholder or a US person who is a US citizen or a resident can own any India entity 100% or 50%, more than 50%, then in that case also this particular form should be filed along with its income tax return. Non-filing of this form will straightforward give you a minimum penalty of $10,000. Similarly, Form 8865 is for the foreign partnerships. So when any US person, again, or US entity is making any transfer to foreign partnership, is making any acquisitions or dispositions during the year in a particular foreign partnership, or making any changes to the partnership interest, primarily these are the reasons when this form gets triggered, then again this form needs to be formed. Point to note is that it is an informational form. You do not have to make any payments or taxes attached to it. It is purely from the informational perspective. The IRS wants to understand that where you are holding a financial interest in any of the non-US entities. Again, the due date to file this form is along with your tax return, in our case, specific corporate income tax return. Next is FBAR, in short, what it is called, Foreign Bank Account Report. It is again used by US persons having a financial interest in or signature authority over a foreign financial account. Important to understand what are financial accounts. It could be deposit account, your saving bank accounts, your custodial accounts could be in the nature of provident funds, or any stocks, bonds, whatever you are owning. So all of these accounts needs to be reported when a threshold for filing such triggers is when you have a minimum balance of $10,000. Then only it gets triggered and you have to file the FBAR along with your personal or corporate income tax return. Similar to FBAR is another form called 8938, which is called Statement of Specified Foreign Financial Assets. It also has its certain applicable thresholds attached to it. The threshold is from a corporate perspective, it's entirely different, which is $50,000. However, if an individual is able to trigger the applicability of this form, then it depends on the status of an individual. In the US, we have multiple tax statuses, and according to that, there are different thresholds to be followed. And that's primarily, again, needs to be filed along with your personal or corporate income tax return if you're meeting a specific criteria. It does not have any specific other due date to be followed. So one needs to understand while you're finalizing your income tax return from corporate perspective, do understand the structure of your entire group, that who are the owners. Are we owning any, being a US person, owning any of the non-US entities, and in what ratio or percentages we have an interest in that particular, because everything starts with in understanding how much interest do we have in a particular entity. And a primary threshold which US has given is to understand if I'm as a US person owning more than 50% control in any non-US entity or not. There are other criterias, of course, and that is where your tax advisors like us can assist you in understanding the complexity and the different categories or requirements of this form. Akhil, any question or?
No, I think I want to understand more. If you can elaborate on some forms like Form 547, Form 8865, and for the interest of larger group who's listening to you.
Sure. Thanks, Akhil. So thank you. I think I preempt your question, and we have a slide followed by this to have a detailed understanding on these two particular forms. Bobby, can we have the next slide, please? Yeah. So let's talk more in detail about the Form 5471. As I said that, it is an information form. Number one, you have to understand there is no tax to be paid via this form. It is all from the perspective of understanding that no fraudulent activity or no fraudulent entity has been formed in the non-US jurisdiction where the money can be adjusted between the two countries. So that is primary intention to understand. The details are more around from the perspective of its financial activity. So this will include filing of the balance sheet, income statement, any other relevant financial data of a particular non-US entity. And it is applicable to US citizens, residents, domestic corporations who have ownership interest. Point to note here is ownership interest is something very, very important to have in the non-US entity. Then only it gets triggered. As I said in the previous slide that 50% is the control interest which IRS has given as a indication. So those particular entities are called as CFC in short, and otherwise they're called as controlled foreign corporation, which means if I, being a US person, owns 50% or more in any of the India entity, then this particular form will get triggered. Fine. At the same time, if I'm making any changes to my interest in these particular entities to an extent of 10%, either I'm adding or more ownership interest equivalent to 10% or disposing of my equivalent to 10% or more interest in a particular year in the same entity, then also I have to continue filing this particular form and report the details to the IRS. We discussed that the due date to file the return is along with the filer's income tax return. In our case, it is the corporate tax return, which is called as Form 1120. It will go along with that particular form. And the penalty for not filing one particular, each foreign corporation, it gets applied to 10,000. So if you have, let's say, missed reporting 5 entities, 5 foreign corporations, then a 50,000 penalty is minimum what will be applicable. And let me highlight that IRS is very, very serious when it comes to filing Form 5471. Even non-filing, let's aside, if there is any misreporting attached to it, it gets triggered very easily. Parallel to it, we have Form 8865. The difference between the two is one is for the corporations, the other is one for the partnership, but both are foreign partnerships. So again, this form is informational in nature and it involves the activities of a partnership entity, be it from the income, expenses, assets, your balance sheet, any other financial relevant data which needs to be provided. All of that gets, populated on a particular form of 8865. This has to be prepared per entity basis. Multiple entities cannot be clubbed in one single form. Similarly for 5471 as well. And it is applicable to all the US persons. Here the US persons include US corporations as well, not just the US individuals. And similar to, again, 5471, the penalty is same and the due date of filing the return also is same, which is along with your primary income tax return. Akhil, I hope that I have addressed your concerns. Okay.
Yeah, that's very detailed out. Thank you. And we have been talking about, though the theme of today's session is about corporation, how we can form the entity, the kind of different entities. You and Mr. Sharma has been talking about this. I think a lot of people have put in the questions about what about the foreign tax credit for individuals? What all credits are available for individuals, in US? And then if we can quickly, touch upon that, I don't know whether you covered this in your slides or not, but if you can quickly, talk about that and maybe in interest of time, because we have Mr. Kris Sharma also to come in and, give his perspective, his overview, and though he's been adding a lot with you as well, but yeah.
So I'll just take a brief on the foreign tax credit available to the individuals and then requesting Mr. Kris to take it forward from there. So I think that's the only ray of hope when it comes to getting one entity or any individual being taxed in 2 jurisdictions. The foreign tax credit means that you are getting a deduction dollar to dollar of whatever taxes being paid in a particular country. We have to understand this concept with an example. Let's assume I'm a US person. I am living in the US. However, I was an India citizen once and now moved to the US permanently. So from an India perspective, I'm a non-resident for a particular year. However, I continued with certain investments in India in the form of mutual funds or your bank accounts also, because that also generates interest and the tax gets deducted. So for India source of income, I will be applicable to pay taxes in India and will be filing my applicable return here. However, from a US perspective, since I am a resident in the US, I have to report my worldwide income. Very important point to understand that I have to report my global income, which is US income plus my India income. Now, you would be worried that, since I'm paying taxes in India, and again, somebody is asking me to pay taxes in the US, I will end up paying double taxes in 2 different jurisdictions. This is a ray of hope. As I said, foreign tax credit is something which gives you an option, or rather it is a facility given that whatever taxes you have paid in India for that particular period, on the same source of income, you can take a credit on your US tax return. Point to understand is that credit will not be equivalent to amount whatever you have paid in a particular year. There are certain computations and calculations attached to it when it comes to computing a foreign tax credit in the US. However, for some reason, you're not able to avail the entire credit, the same gets carried forward to the future years. So you will be able to avail the same, but in a piecemeal manner. So that's number one to understand. Number two, vis-a-vis the foreign tax credit, which gives a dollar-to-dollar deduction, there is another, deduction, foreign exclusion deduction is also available that can also be availed, but it has its certain nuances around attached to it, and it is not a dollar-to-dollar deduction. When it says, when we say dollar-to-dollar deductions, means that whatever total taxes are applicable credit can be applied against that, and your overall taxes will get reduced. However, in case of foreign exclusion deduction, your taxable income gets reduced. So the impact of the two things will not be same. Therefore, the credit is always the preferred means to reduce your taxes. So on that note, I hand it over to Mr. Kris to add on this point, and I'll also try my best to add more knowledge to it.
Thanks,
So
Nikita.
you're on mute.
No, Mr. Kris, you're on mute. Thanks, Nikita. Now we'll ask Mr. Kris to, take us to, because he's 30 years of experience, though he's been sharing his thoughts, was take us to, different integrities and complexities and requirements in US. Obviously,
Thanks.
yeah.
Thanks, Nitka. Just to add to this point on foreign tax credit, number one, first thing to understand is, are we taxed on domestic income or global income? And who is a resident in the US? Who's a resident in India? What are the residency rules from a taxation point of view? Number one, let's take US first. If I'm a green card holder, or if I'm a US citizen, or if I'm living in the US for more than 182 days, I'm a resident. Now, being a resident of US, number one, I'm always a resident if I hold a green card and I hold a US passport, or I hold a US passport despite the number of days in the US. I'm a green card holder living in India, I'm still a resident of US. So if you are on an H-1B visa in the US and you are in US for more than 182 days, you are a resident. There are different treaties, like a person who goes, but those are treaties. Those are treaties between countries, like India and US. Like a student goes to study in India and is working, he's always treated as a non-resident. He might be there for 3 years. So we're not going to go into these exceptions. Now, being a resident of US means you are taxed on global income. So I go on an H-1B visa, I stay in US for 4 years. I'm a resident of US. I'm required to disclose and report my Indian income. But I also have certain income in India. I could have bank accounts, I could have interest income, I could have rental income, and I've paid taxes in India. So also because of these tax treaties, you're not exposed to double taxation. So if you pay taxes in India, and you report that same income on the US return, you will get a foreign tax credit. Now, the foreign tax credit is a very simple methodology of what is the amount of that foreign tax credit. It is your foreign income divided by your global income multiplied by the US tax liability. So, you calculate your US tax liability after adding your foreign income, and suppose it comes to $40,000, and your foreign income is 50% of that. So your credit will only be limited to 50% of 40,000, which is your US tax liability. And when we calculate US tax liability, we get a lot of deductions like standard deductions and all. So your credit will be limited to the percentage of foreign income versus global income times US tax liability. So that was one point I wanted to mention about the residency status. Now in India, the residency rules are based on substantial presence. If I'm in India for 182 days in a particular year, 365 days last 4 years, 765 days last 7 years, then I'm a resident. Then I'm required to report US-based income also. So that is the methodology of calculating and determining whether you are you report global income or you don't report. There are, of course, different exceptions. I'm a student in India. I'm a student from India who goes to study in the US, and I'm also working part-time. I'm always a non-resident as long as I'm on an F1 visa, but those are exceptions. So, just to elaborate on that point. So, Akhil, what is the? Do I go to my slides? What is the sequence
Yeah,
now?
just a minute. I think there's one more slide which Nikita wants to cover, and
Yeah.
after that we can move to your slide deck. Yeah, Nikita, you have last slide after this, or it's I think you have one more slide to cover, I believe.
Yes, so that was mainly on the tax credits available to the business. We are having a discussion on. This is point to remember is this is or these specific examples of tax credits are applicable to the business and not to the individual. So what we discussed Last is on the foreign tax credit, that is though available to the business as well. But primarily the detail was around addressing a concern from the individual income tax perspective. However, for the businesses, let's say you have a technology company and looking forward to innovate and make some development in the US, and that's how you are looking forward to do the expansion in the US. So then there is a research and development tax credit available to you. Again, it is dollar to dollar deduction to your overall taxes. However, important point is it is not that straightforward to conclude whether the research or the development which you're doing for your innovation will meet the criteria of the IRS prescribed law. It has a very detailed definition that what all expenses can be considered which are spending on the research and development, but it has to be mainly from the innovation perspective. So a detailed study is required to understand if an entity is eligible for a research and development credit or not. However, the first understanding one needs to have is that those expenses are to be incurred from the US entity by being present in the US. You cannot have the research or development being done from outside India as a parent entity and then expecting to have a deduction on your US taxes. So these are the important points to remember while even to think that whether one entity is eligible for this particular credit or not. Again, there are forms which is applicable called as 6765. So yes, there are a lot of form numbers in US one needs to remember, but one gets used to it as long we go along filing the taxes in the US. So 6765 is the applicable form for R&D credit. Followed by that, investment tax credit is another type of credit applicable to the business structures. It mainly revolves around, if an entity is looking forward to invest in assets like machinery, equipment, property, of course, for business purposes only. And it should have a goal in rehabilitation, energy, renewable energy, any qualified advanced coal project if it is happening. So all of these, kind of businesses, if you're looking forward, then there is a specific set of credit called as investment tax, which can also again be availed. I really want to emphasize one point that to avail such credits, these are not so straightforward in the US that, you think that your business will be able to match up the definition. However, again, it's a ray of hope that the more closer you are meeting the definition of these credits as part of your business objective, there is a huge likelihood of availing these credits. However, a detailed analysis should always be performed because while you are going to claim this credit, they are going to ask a whole set of documentations attached to it, not just simply filing a particular form. So hence a detailed study should always be conducted with consultation with your tax advisors. Last but not the least, work opportunity tax credit is something available only when you're looking forward to hire employees from a targeted group. So there is a 10 targeted groups listed by IRS. If you are, your entity or business is hiring from those particular group, then to the extent of 40% of $6,000 per employee pay, what is being paid, then that particular amount can be adjusted as a credit. But again, a specific form has to be filed with an applicable due date to claim such credits. Lastly, I think I've not covered that particular credit, but that's a lot in discussion recently. This is called employee retention credit. So during, it goes back to the time of COVID-19 primarily, when the businesses in the US who are facing a lot of challenges in retaining their employees, or even if they did, there were a huge loss in terms of gross receipts. So if you're meeting primarily these two, scenarios, in that case, IRS came forward and said that you can avail an employee retention credit, which means $10,000 per employee, if I remember correctly, can be availed as a credit to retain those employees. So that is still applicable if entities hasn't applied for such credit in the year 2020 or 21. There is a timeline still pending in the year 2024 where you can go back, amend your tax returns and avail for such credit if you're meeting the criteria. So these are the important tax credits I wanted to discuss from a business structure perspective. Over to you, Akhil.
Thank you. I think very insightful, as I've been telling you since beginning on each and every topic which you've discussed, has given a lot of insights to me, though I'm not practicing this US tax from anywhere, but now I can actually have that, confidence that I can actually pick this up as a conversation and add some value wherever it's required. Thank you. I think our audience is equally enjoying it. We've seen a lot of participants today. Now let's move to another slide deck which Mr. Kris Sharma has to present to the audience, and hear from him on the perspective and the challenges and opportunities we have in US. Over to you, Mr. Kris Sharma. Can we have his slide deck on the
Thanks,
screen?
Akhil. Yeah, I'll just maybe it's a part of this presentation on credits for individuals, but we can go through, and if I don't see it, I'll discuss it. So you're gonna go to the next slide, please. Yeah. Okay, applying to the state, as you mentioned, we set up entities in the US at the state level, and you have to choose an entity, and when you choose an entity, there are a lot of things that we, of course, Delaware is a more compliant state to go to. If I live in and work in California, but my business is in California, so I would rather register in California because all my compliances will be in California. And of course, Nitika covered all the details about getting an EIN number, opening a bank account, all the articles of association and all. The key thing to remember here is that are you C corporation is a person by itself. It has a legal identification. It pays its own tax. All the other ones, the LLCs, the S corporations, partnerships, are all flow through entities, which means basically you have to file the returns, but the income gets allocated to the owners through a form called K1. And what are the advantages and what are the disadvantages, and who are the eligible members? Like S corporations can only have residents of US, Canada, or US or Mexico. Partnerships, the other thing to worry about partnerships is that, in India, partnerships are a taxable entity. The partnership pays the tax, but in the US, the partnership income is allocated to the partners. So there's a bit of mismatch, but whatever taxes are paid by the partnership are sort of transferred to the proprietor. So Nitika's covered all this in detail. I'll go to the next slide. Yeah. Okay, same things. Compliance states, we've covered everything here. Nitika covered this all in details. For flow-through entities, it is 2.5 months after the calendar year, which is March 15th, and for individuals and C corporations, it is April 15th. Just like Nitika said, you have to pay your taxes by the due dates, but you can get an extension to file the returns. So we'll go to the next one. Okay, state compliances. Now, how much is the cost? The cost to register an entity, and what are the compliances you have to deal with when you have an entity in a particular state? Firstly, to register an entity, you have to pay something to the state, and invariably, the range is between, I would say, $199 to $299. So in about $200 to $300, you can register an entity. And then there's an extra charge for getting an EIN number, and then other compliances also. Other compliances of getting an EIN number and all the stuff. So the registration agent will charge you about $299. So if you add all these factors together, you're looking at a cost of about $600 to register an entity in the US. Second is that on an annual basis, what is the payment that I have to do? You have to pay franchise tax. What is franchise tax? Franchise tax is a tax for having an entity in that state. Now, franchise tax is calculated based on your issued capital or on your assets. So when we register an entity, we worry about how much assets you have or how much we keep your issued capital very low so that your franchise tax is very low. This is an annual payment you'll have to do. The second annual payment you'll have to do is you'll have to file an annual report every year. If there's been a change in the directors or the owners, you have to file that. Or even if there's no change, you have to file that. And so that is a cost. And then, of course, a registered agent charges on an annual in the US mostly around $299 per year. So $600 to register an entity, $299 to meet the registered agent fees every year, and compliance and franchise tax, it's not much. So we'll go to the next slide. Okay, so what are the kind of taxes an entity is exposed to? One is income tax. Income tax is levied at the state level, at the federal level, and at the state level, and also maybe at the local level. Like I'm an individual living in New York. I will pay taxes to the federal government. I'll pay taxes to the New York state, and then I'll pay taxes to the New York City also. So one is income tax I pay. The second one is on all your active income. Now, what is active income is, your self-employment income, your partnership income. If you're a general partner, your salary income, your W-2 income, you also pay Social Security. Social Security is basically, it's a non-refundable thing. You contribute to Social Security and it is 15.3% of your total salary. You pay that, and what is Social Security is you have to contribute to Social Security for 10 years. 10 years means 40 quarters, so that when you retire at the age of 65, the government will give you Social Security and Medicare, like it's free medical benefits. So income tax is one taxation you pay to the state and the federal government. Social Security is what you pay to the federal government. And then also, the other taxes a person could be exposed to could be exit tax. If you're surrendering your US citizenship, and on an average you've been paying $200,000 less, then you're also exposed to exit tax. The last kind of taxation a person is exposed to in the US is based on your total net worth. So, which is called the gift and estate tax. So if you have a lot of property, you have a lot of assets, and they exceed over $15 million. Right now, the quantum is $15 million. You have to pay the third kind of tax, which is called the gift and estate tax. And this limit of $15 million is going to be reduced. So a person is exposed to income tax, Social Security taxes, and exit or gift and estate taxes and all the stuff here. Now, from your active income, you have to you are exposed to payroll taxes, which are basically your Social Security taxes. 15.3% of your salary income or your active income. Can you go to the next slide? Yeah. Okay, these are the
I think Mr. Kris, Nikita has some point to on the previous slide to add on. Yeah, Nikita, wherever you feel like you can add on.
yeah,
Thanks.
sure.
Yeah, thanks, Akhil. In fact, prior to this slide, I wanted to add a point for setting up of an entity specifically. Sir mentioned that the cost is, ranges between $600 onwards, but the minimum is something of that sort. So, important point to understand here is the cost is defined majorly from a perspective of authorized share capital, which you are deciding to create an entity with. So in Delaware state, you can set up an entity with a minimum authorized share capital of 1 as well. And that will have a minimum cost of $225. However, in certain other states, there are requirements that, you cannot form an entity with a single authorized share capital, but they have a minimum cap to it. So this is how the cost of setting up will definitely be changed as far as you increase the authorized share capital. It has cost attached to it, so one needs to be very mindful while setting up an entity in the first year itself, that how much is the number you are looking forward, and under which class of stock also you are looking forward to create an entity. Number 2 point which I wanted to make is that there is an expedite cost also available, which is generally $100, that if you're looking forward to form an entity within a day. Otherwise, every state has its own timelines to form an entity. It could range from a week to month as well in difficult situations, but still a week or 10 days is minimum, what we have seen in our experience. But states do give you an option to set up an entity overnight, which is just at an additional cost of $100. So these are important factors to be considered while setting up an entity. So I thought that I should highlight those. Thanks, Akhil and Kris.
Yeah, thanks, Nitika. And also bear in mind, that you have to figure out in which state you have your corporate office, in which state you have your employees, because there's a nexus treaty between states which says that I can't base myself in Delaware and not pay any taxes in California if all my employees are in California, or if I have my corporate office in California. So we do a comparison between the simplicity of setting up a corporation, and then compliance also. So if in the Nexus Treaty, as I mentioned, in one of the points earlier, that if I have a corporate office or I have an independent contractor working in that state, or I solicit business in that state directly, then I'm exposed to taxation. I have to register that entity also. So all these blend factors have to be blended together in deciding, where and how to set up an entity. Okay, coming to payroll, just, as an individual, if you hire as an entity, if you hire employees in the US, what is your obligation from an entity point of view? So an employee is exposed to, social security taxes. Income tax is withheld from, when we talk income tax, we talk of federal income tax, and state income tax is withheld from his salary. As an employer, you are liable for 50% of his social security taxes. So if you hire somebody, 7.65% of his salary comes from your contribution, from the employer contribution, and 7.65% comes from the employee contribution. So those are payroll obligations, and of course, from which you contribute for the employee. The other obligations which an employer has in the US is unemployment. You have to pay, and that the employee doesn't contribute to it. You pay for unemployment, you pay for compensation, accident compensation. Those are direct payments which are employer obligations. But the main obligations that an employer is exposed to is 7.65% of the salary as social security taxes. And of course, for you file social security returns on form 940, 941, and you have to do that every quarter. So go to the next slide. Okay, credits, of course, how do I make sure that my tax is organized, my structure is organized in such a way so that I get, I optimize in tax effectiveness. I pay the least amount of tax. One concept was tax credits. So, we have R&D tax credits, we have energy credits, we have employee retention credits. We do, solar energy credits, work credits. If you hired somebody who's unemployed, you get a credit for the wages that you and there are some startup credits also. So all these credits are given at the entity level. At the individual level, what are the credits that one person is eligible for? We have child tax credit. So any US resident having children under the age of 17, gets a credit for having that child. But of course, there's a phasing out. If your adjusted gross income is above a certain level, you lose that credit. So we have child tax credit. We have earned income credit. Earned income credit means my income is very low. I have that. You have education credits. There are two kinds of education credits. You send your kids to universities. You got the American Opportunity Credit. You got the Lifetime Learning Credit. All these credits are available to you. And employee retention credit, we've done a lot of ERC claims for many companies. I think there's a particular slide on that. I'll go through that here. And then there's startup credits also. So you go to the next one, next slide. Okay, employee retention credit. Okay, number one, it's no longer a credit anymore. What's the difference between a credit and a refund? A credit means if you have a tax liability, your tax liability is reduced to the extent of that credit. So now the IRS is not giving it as a credit, it is giving it as a refund. So during the year of COVID, in 2020 and 21, if your business suffered because of COVID and because of any government legislation which said that you have to wear a mask, you cannot have more than 10 people in a restaurant, and you were affected, you could be eligible to get up to $26,000 per employee. And the way it worked was that for the year 2020, it was 5,000 per employee for the whole year, and for each quarter of 21. Quarter 1 of 21, quarter 2 of 22, 21, 23 of 21, you are eligible for 7,000 per quarter. So the maximum wages that are eligible are 10,000 per year. 10,000 per year in 2020, and the credit is 50% of that 10,000. So it makes it 5,000. The maximum credit you're eligible for each quarter of quarter one, quarter two, quarter three is again the wage base is 10,000, but it is 70% of that per quarter. Now, quarter one, everything in 2020 has expired. So basically, right now, you cannot get 26,000. It is reduced by 5,000. So now you are only eligible up to $21,000. And even the first quarter of 2021 will expire on April 15th of 24. And then similarly, there are two criterias by which we calculate this credit. One, and these all legislated. One is that, if there's been a revenue decline of more than 50% compared to the base year of 2019. So 2019 is the base year. You compare quarter one of 2019 to quarter one of 2020 to quarter one of 2021. Now, if between 19 and 20 there's been a decline of 50% in the revenue, then you are eligible. If there's a decline of more than 20% between 19 and 21, you are eligible also. So that is one criteria, revenue decline. The second criteria is if you faced any hardships because of any government legislation, and now your sales might have increased, but there was still hardship. Like if I projected my revenue to be maybe $5 million, but I ended up only at $3.8 million, then because of all this hardship, I could still be eligible for that. And there are very particular detailed methods of computing that. There are laws which state that do you have 100 employees or you have more than 100 employees. So it's an employee retention refund that's still available to companies only for the year 21 now. I think between Nitika and me, we've covered most of the things. If the audience have any questions, we can all take it together. Yeah.
Yeah, so one of the questions which have come is, please elaborate more about gift taxes. Either you or Nikita, whoever wants to take it up.
Is it at the individual level or at the corporate level?
That's not
okay.
mentioned in the question.
Nitika and both of us can take it. Coming to taxation, we have graduated scales, right? Number one, we are allowed certain deductions. Number one, there's a standard deduction, and we have 5 filing statuses in the US. I'm talking at the individual level.
Yeah, the question is about individual level. The person has just mentioned that. Yeah.
Okay. So I'm a single person, so I file my return as a single person. Secondly, I can file my return married filing jointly. I can file my return married filing separately. I can file my return as a head of a household, which means, I'm supporting my parents, I'm supporting my kids. I can file as a head of a household. And the fifth one is I can file as a widower. I lost one of my spouses, I lost my spouse, and I remain unmarried for 2 years. So each one of these filing statuses has a certain standard deduction. Which basically means if let me give you one example. I'm a single person filing. If I make less than $14,500, I don't have to pay any tax. I don't pay any tax. So we take that standard deduction. Now, so we have income, we have different kinds of income. We minus from the income some adjustments. I contribute to Social Security, I can contribute to retirement accounts, I get a waiver or a postponement of paying taxes on the contribution. I can contribute to a health savings account. So there are different deductions that are available. Income minus certain deductions. I come up to a figure called adjusted gross income, from which I take a standard deduction, and I come up to my taxable income. Now, from my taxable income, there are tax brackets which will apply. Say up to $10,000, I pay 10%. From 10,000 to 40,000, I pay 12%. You calculate that. Now, the second thing to understand is that we have taxation at slab rates, which is the regular taxation. Capital gains tax rates in the US are different. The capital gains tax rates are 0%, 15%, or 20%. So those are the capital gain rates, but then we have slab rates also. And then, of course, from the Once you've calculated your tax liability, you have a deduction in the form of payments that you have done, advance payments that you have done, withholdings from by your employer, and then you have tax credits like foreign tax credits, uh, child tax credits. I also get a credit for parent, I elderly care credit. I send my kids to a daycare. I get credit for that. So at individual levels, there are quite a number of credits that are available to you, which you can offset, and then you calculate your tax liability. Now, the only extra thing that comes into play is that if my income is over $200,000, I contribute 0.9% more to Medicare. So anytime my adjusted gross income is over $200,000, I contribute 0.9% to Medicare. And then also, if I have any kind of passive income, there's also an additional investment tax also. So all those taxes are we have a concept of alternate minimum taxation. My income is over $200,000. I have passive income. Then I lose a certain amount of my standard deductions, and I pay the higher of the two. So in a nutshell, that is the income tax. And then, of course, gift and estate tax. As an individual, a lot of people become worried about gift and estate tax. So what is gift and estate tax? It is the total net worth of all your assets worldwide. Like in India, I've got properties. I've got a company in India. I've got assets in India. So the total combination, the total cumulative total of all the gifts you have given throughout your life, plus the fair market value of all the assets in your estate at the time you go. If it is over $15 million, which is the limit now, you pay an additional gift and estate tax, which is very hefty and almost as good as 40%. So a lot of people do tax planning around that. They set up trusts, they transfer properties to the trust, and they become beneficiaries, or their kids become beneficiaries. So all those mechanisms are involved. So income tax, social security taxes, exit tax, and gift and estate tax here.
Yeah. I think Nikita wants to add. Nikita wants to add because the question is more to elaborate on the gift taxes. So yeah, Nikita.
Yes, thanks, Akhil. So the question in discussion is around the gift tax. So one needs to understand that being a US person, whether I'm a donor or a donee, in case of gifting any asset to another person. So let's say if I'm a donor and being a US person, I'm gifting some property to another individual on an annual basis, there an exclusion of every year basis the inflation rate, the threshold changes. But I think for 2024, it is $21,000, where you do not have to make any reporting. You can very freely make such gift to any of your friends, family, and personal relatives without any reporting of the same. However, IRS also gives you a benefit of lifetime exclusion limit, which is at the currently at the moment going on to the extent of $12.6 million, rather $12.9 million. However, by 2025, this number is expected to come down almost half of it, which is approximately $5.6 million, where you can avail your lifetime to make any asset under this threshold free of tax. However, beyond this number, there are gift tax implications involved. And then it depends on the type of asset you are making the transfer. So these are the two things one needs to be careful about while making any gifts. And annual, as we discussed, that the threshold is 21,000 and it keeps on changing. So you do not have to worry on the reporting perspective, let aside the tax payment. And similarly, on receiving of the fund from, a gift from a non-US person, in our case, since we're discussing India and US, if you're receiving any gift from India person as being a US person, there is no limit to it. You're free to receive that and not to pay any taxes on the same. So I hope we have addressed the question.
Yeah. Thanks, Nikita. I think last question before we conclude today's session. I think, Nikita, over to you. People are asking, what is a domestic corporation, and does shareholder needs to be a US resident, or it can be anyone else?
Okay, so domestic corporation is Chapter C corporation definition where we discussed. while creating a C corporation, you do not need to have a US person as a shareholder. Anybody can be a US person, and that is the main differentiation while creating a S corporation. S corporation requires all the US persons to become a member or a shareholder of the S corporation type. So in our scenario, particularly if being a US India person, you can very well form a C corporation in the US.
Thank you.
The shareholders of a C corporation can be an individual from India, can be a partnership from India,
Yeah.
can be a company
Or
in
any
India,
other
but
type, not just
any
individuals,
other
but
type.
anybody, but specifically to concern non-residents in any type of
In any
entity
type,
they
exactly.
can be.
And for S corporations, it has to be a resident of US or Canada or Mexico and all the stuff. Yeah.
Thank you. And with this, I think we can conclude our session for today. This is the second series we have done on the US related issues, opportunities, compliances, be it at individual level, be it at corporate level. I think both the speakers have given a lot of insights and then points to ponder. And I'm very grateful that we have good participants, almost 200 people attending the sessions today. If we have a positive response, then we might again ask Nikita and Kris both to come over and give. I think it will be more challenging for us, but we'll have more case studies. Different aspects. You can see the reaction we are getting from the people. It's overwhelming. And thanks once again. By this, we conclude our today's session and obviously people are asking whether we share the slide decks and all. We'll do that. I think we've done in the previous session as well, and we can do that as well now.
Akhil, one point which came out of the last seminar and even the one that I conducted in Chennai was on sales tax.
Okay.
Now, a lot of times, we register an entity in a particular state and we distribute our products to different states. So a lot of people do ask us, do we need to register for sales tax? Now, so the difference between income tax and sales tax is that sales tax is a consumption tax. So wherever your item is consumed, it could be a service that is consumed, or it could be a tangible asset that is sold in a particular state. You will be liable for sales tax. Now, what makes you liable for sales tax are a couple of factors. Now, say and these are very important points, because this question has been coming, and from all these seminars, we've been advising a lot of clients, and we're also representing few clients, and they're all asking us, do I need to register for sales tax in this state also? So the criteria is, say, I'll give you one example. Say I'm a Delaware corporation. I'm based in New Jersey. I'm a manufacturer, and my goods go to California. My goods it could go to different states. So number one, if you're a part of the Nexus Treaty, a Nexus Treaty is an agreement between all different states, which say that you should basically allocate a part of your income to our state because you're doing business in our state. So what makes you liable for income tax and sales tax to that state is your presence in that state in a form of employment of a contractor. You have an independent contractor there, a marketing person there, or you have a tangible office there, or if you're doing direct solicitation of a business in that particular state, you are liable for tax. So now the minute you are liable for tax, you have to register for sales tax also. And different states have a sales tax, there's no exemption because it's a consumption tax. For income tax at the individual level, Florida is a tax-free state. You don't pay any individual taxes also. But for sales tax, California could have a 7% rate, could have a different rate also. And sales tax is a very complex area because
Yeah.
yeah.
So I think we need a session for that. We'll not be able to do the justice to just
Exactly.
today. So we'll plan out something, and we'll plan out an agenda, and maybe we can have a separate session for that, because we want to continue with this series. At least we
Sure.
want to have one more session on these kind of things. We'll take a input, and we have a lot of questions which we have not answered. Maybe from those questions we can pick up the queue. But for today, I think this much, whatever you guys have given is I'll ask audience leave audience to digest this much at least, and then, you know, maybe we can have separate sessions and series going on. Thank you once again on behalf of Indian-American Chamber of Commerce. I'll thanks everyone for attending this session, and thanks the prominent speaker once again, and have a nice evening. Thank you.
Thank you so much, everyone.
Thank
Thanks,
you.
Akhil.
Thank you, Nikita.